Joining us right now is Chief Investment Strategist for CFRA Research, Sam Stovall. Sam, good to see you.
Maria, good to be here.
Thank you so much for joining us. We want to get your take on the backdrop. Obviously, you're an expert in terms of what we're going to see in terms of earnings growth and all that. But what do you make of this big sell-off that we're watching?
Well, I'm looking first off that it's a retest of the initial sell-off that we had. I mean, we went down 10.2% in the shortest amount of time since World War II. So we definitely needed to have a retest of that 25, 30 intraday low, and my feeling is we probably go and test the 200-day moving average, which is around the 25-60 area, and whatever the reason, whether it's Powell, whether it's trade tariffs, whether it's other concerns, that's the trigger that's causing us to retest.
All this, when you got a backdrop that is pretty good, Jay Powell said it yesterday, new Federal Reserve Chairman testified again on Capitol Hill, basically saying to the Senate Banking Committee, yeah, the economy is doing well. He also voiced concerns about the state of our fiscal path, despite the strong economy. Listen to this.
We're not on a sustainable fiscal path. We need to get on one. This is a good time to be doing that when the economy is strong. That's a longer run problem. It isn't really, it's not a problem for today's monetary policy or economy. It becomes a problem gradually over time.
So, Sam, the Journal writes it this morning in the top stories. Powell offered an upbeat view of the economy, opening the door to 4 rate increases this year. He didn't say that, but everybody's speculating it's 4 increases. Do you think that's the case?
Well, we're still holding at 3 increases this year, but obviously leaving open the possibility of 4. I think what really happened on Tuesday when he spoke to the House was that most people were assuming that there would not be a rate increase in March because of the market turmoil. And then once he said, no, things look good, we're going to continue on our rate tightening path, I think investors then figured, uh-oh, March is in the crosshairs.
Powell's in a tough spot right now. He's trying to manage a very difficult monetary environment. Now you've got tariffs layered on top of that. We're already seeing that affect the market. Do you think if these tariffs stick, if we get 25% on steel, 10% on aluminum, do you think that influences what Powell and the Fed do this year? Do you have to bake that into your forecast?
Well, I think you have to bake that uncertainty into your forecast because what the Fed is trying to do, it's almost like launching a missile over a hill that you can't see. So they have to look 6, 12, 18 months down the road in terms of where they think inflation is going to be, and certainly higher tariffs are going to be inflationary by nature. It's also going to be...
And also destroys jobs. So, I mean, it's like the worst of both worlds.
Exactly, because it will adversely affect productivity, cause retaliation. You know, so when you think, well, who is the biggest loser? Probably the soybean farmer. So the problems are, you know, where can these other countries get back at us?
In forms of retaliation, you and I were talking off camera about one of the scariest forms of retaliation that I could think happen, and that's them selling off our treasuries.
Sure. I mean, initially the thought is that, well, because America is the world's biggest consumer, well, then they've got to take our money. But then what do they do with our money is the big question. Usually they put it into treasuries for safety purposes, transparency, et cetera. But now if it ends up being, well, that's the only way that we can retaliate, well, then that presents a problem
What
here.
are they going to do? Where are they going to put that money?
Oh, agreed.
Let's assume they start selling treasuries. What are they going to do?
Well, I think they would like to try to distribute that around the globe, but I think the point you're trying to make is where are they going to go? They're not going to buy the Swiss franc.
I mean, I just push back on this whole idea that all of a sudden they're just going to dump all these U.S. treasuries on the market. I mean, I get it. I understand it. It's a worry. But I don't know where. This is where they deem safe.
Mm-hmm. But I guess the difference is it's uncertainty, and that's what Wall Street doesn't like, because well, maybe they do come up with solutions that we had not considered, but it's the uncertainty factor.
Well, and there's so many ways that you can make a surgical strike on Mitch McConnell, like with bourbon retaliation, or with Paul Ryan and Harley Davidson retaliation. I mean, you don't have to go that big even with the treasuries. You can just hit little political pockets and create enough damage that the 2018 midterm starts to look bad, and then the whole context changes, right?
Right. Well, going against bourbon, would that be against the grain? So, yeah, I guess that could be a concern. That, and that's what usually is why the midterm election year is the weakest year of the 4-year presidential cycle, and why the second and third quarters are the 2 successive negative quarters because of the upcoming uncertainty and the likelihood now that the Republicans will end up losing the House.
Midterm year is typically the weakest for the stock market?
For the stock market of the 4 years. years, and that the second and third quarters are by far the weakest of the entire 16-quarter presidential cycle.
Real quick, you still expecting 18% earnings growth for the S&P 500 at 18?
No, 18.5. Actually, the backdrop is getting better.
There you go.
Pretty good.
Sam, great to see you.
Thanks.
Thanks so much. Sam Stovall.